Hello and welcome to Any Answers Answered for June 2023. As ever, Tim and I have had a look through the pages of Any Answers, picked out a couple of questions to have a look at. And our first question this month, Tim, comes from Peter Cooper UK, and it relates to national insurance, Class 1 national insurance. As he puts it, the total amount of a £10,000 plus director's loan. And the point of the question here, of course, is that once a loan goes over £10,000, it becomes chargeable to national insurance. Peter has read somewhere, it says, that if the loan is over £10,000, 13.8% of the entire amount is liable to Class 1A employer's national insurance, and he queries what is the entire amount of a director's loan account for this purpose. If the overdrawn loan was for £15,000, but just for a week, but then repaid, would the company have to pay £2,070 of Class 1? Well, Tim, I guess the question is, how does this particular rule work?
Well, let's start by, and I'm putting it into my calculator, working out where the original poster has got the £2,070 from. And that £2,070 is 13.8% of the 15,000. So what they're doing is taking the maximum level of loan during the year. They're saying it was overdrawn by 15,000 for a week and then repaid. Would it be 2,070 on the basis that they're taking 13.8% of the 15,000? No, that isn't right on a number of counts. First, the calculation of the Class 1A is done by calculating the benefit of a beneficial loan, and that would be by applying the official rate of interest, 2% for the tax year just ended, 2022-23. And if we were looking at 15,000 throughout the year, then we would take 2% of that, which is only £300. And you would then have to pay, or the company rather, would have to pay 13.8% of that £300. So we're looking there at, about 42 quid, something like that. So nothing like the 2,070. However, that's not the end of the story, because the question as to how you calculate the benefit doesn't take the maximum loan during the year. What it does is take the average of the opening and closing balance. So we would look at the average, let's say it starts at 12,000 and ends at 11,000, then you've got an average of 11,500 over the year, take 2% of that and apply the 13.8% on that figure. Now, the 10,000 de minimis, that I'm afraid will trigger a benefit in kind if at any time in the year you go over the 10,000. And one of the answers posted to the question by Tax Dragon gives a more helpful example. Suppose that the director's loan account is at the level of £9,900 for the entire year. Then indeed, you don't go over 10,000 at all, and so there's no benefit in kind. But if, for let's say just 1 week in June, it went over the 10,000, the director borrowed an extra 200 quid, so it was 10,100. Well, that triggers the benefit in kind calculation. And what we would then do is calculate the benefit on the average over the year, opening and closing, and take that at 2%. And as Tax Dragon correctly points out, that would give us roughly a benefit of £198, on which you'd then be taking the 13.8%. So the tax charge triggered by that extra 200 on the loan account, the 13.8%, I say tax charge, the Class 1A liability on that would only be whatever it is, about 28 quid, a bit under that. Instead of using the simple average of the opening and closing balances, either the taxpayer or HMRC can choose to use a daily balance method. And that can be used where there is an uneven and material fluctuation in the balance over the year. So that's always worth checking as well. But the original poster, I'm afraid, had one or two misunderstandings indicated in the original question. Tax Dragon gives the right answer, and at this time of year, with P11Ds and Class 1A liabilities coming up, it is well worth reviewing the rules and making sure that the right amount, both for the benefit in kind, I haven't talked about the tax position, but also for the Class 1A, the right amount is brought in.
I think one of the reasons people get particularly confused in this area is there are two totally separate loan issues that need to be considered. The benefit in kind one that we're talking about, where you would take 2% of the loan figure, and also Section 455, Section 419, if you are older, loans to participators, where the tax would be based on the full value. And I think that's one of the reasons people get confused. Worth a brief mention, I think.
That's right. The other thing I would remind us of is that 2% for this year is now 2.5%. So the official rate of interest that I was using in my answer is for 22-23 tax year, which is the one for which we'll be doing the Class 1A calculation shortly.
Second question this month comes from Chance Wind, not sure, who knows. Anyway, the question that is asked, very simple question with an incredibly complicated answer. Transitional profits over 5 years, we are asked, have the revenue told us exactly how this transitional profit will be taxed? The answer is very definitely yes, they have, Tim, but a few of the posts here have raised some interesting questions about how this will work.
Yes, there is a very short question, actually. As you say, have they told us how the transitional profit will be taxed? It's not the revenue, it's the government. Yes, they have. The legislation is there, it's clear. Will the extra profit be taxed over 5 years by some system, or will the whole profit for the extended period be taxed over 5 years? We'll get onto that in a moment. But just before that, as a third sentence, presumably Class 4 will be split the same. And the answer to that is yes. So as in every other case I can think of, except actually sideways relief for losses against employment income, etc., Class 4 will follow the income tax. Now, how is the extra profit taxed? Well, as you say, there are several answers to the original question. One saying, I haven't read the legislation, but can be pretty sure it's one. Always worth looking at the legislation. Somebody else says the alternative would be nonsensical, which is more likely given HMRC's tax record. But anyway, the answer simply is to look at the revenue guidance. Somebody in the answers gives the references to the business income manual, which does indeed have lots of examples. And very simply, if you've got, as we have, a 31st December year end, then for the current tax year, which is the transitional year, we will pick up 12 months to 31st December 23, our current accounting period, plus 3 months of next year, taking us to 5th April 24. And it's the additional 3 months against which we will set the overlap relief for each partner that gives us what you might call the extra profit. And it's that figure, the 3 months less the overlap, that is spread automatically over 5 years starting this year. So for 23-4, in addition to my profit share for the year to December 23, I will also be taxed on 1/5 of my profit for the 3 months to 5th April 24, less my overlap relief brought forward. That's the default position, but there are a number of riders. First, I can at any time accelerate that 1/5. So I could, if I like, have all of the extra 3 months less overlap taxed in 23-4, or have just some of it taxed in 23-4, as long as it's at least 1/5, and then that will reduce pro rata the amounts for the remaining 4 years of the spread. So that's all in the legislation with lots of examples in the revenue guidance. But then there's an interesting point, and that's what really gave both you and me pause for thought. The interesting point was brought to our attention by POSSEP, P-O-S-S-E-P, who referred us to example 15 in the Revenue Business Income Manual. And it's an example where the business has a 30th of June year end, and there's a loss for the year about to end. So a £10,000 loss in the year to June 23, and then a change of accounting date, the 31st of March 24. So there's then a 9-month period that shows a profit. And the effect of the legislation, it's really quite interesting, I hadn't picked it up before, is they've got overlap profits brought forward, but the effect is that whereas if there'd been no change, the loss in the year to June 23 would have been allowable in the normal way, possibly with carryback, that loss will effectively be absorbed in the transitional calculation and be spread forward in its effect. It'll reduce the forward spreading, and so you won't get the benefit of the loss quite as quickly as you would have done had there been no change in the legislation. But at this point, I would simply recommend AccountingWEB subscribers to have a look at the revenues manual examples, not just on the loss followed by profit, but all sorts of other examples, and begin to get a feel for just how much scope there is for manipulating the taxable profit or loss, and hence the all-important tax cash flows as we deal with this transitional year, moving us onto the tax year basis in full for 24-25.
A hugely important topic. And I know I keep saying this, but one that we really must make sure we are speaking to people about and considering the implications of as soon as we possibly can. This one isn't going to go away. It needs to be confronted quickly. That's all for this month. Hopefully see you next month when perhaps it'll be your questions we're having a look at. But for today, bye-bye.